Welcome to Iron Financial. There's a tectonic shift happening in the marine industry right now, a move that demands your attention. Two heavyweights, MasterCraft and Marine Products, are joining forces. Today, we're going to hammer this deal apart and figure out if they're forging a new marine empire, or if this whole structure is destined to take on water. Let's get to it.
Okay, here's our game plan. First, we're going to inspect the foundation, the state of MasterCraft before this deal. Then, we'll pull out the blueprints for the merger itself. We'll look at the bull case, this grand vision of a new fleet. And that leads us to the critical question of synergy. From there, our market skeptic is going to start looking for cracks in the hull, outlining the risks. And finally, we will deliver the iron verdict. Let's dig in.
Look, before you start a massive construction project, like bolting two public companies together, you have to do a structural inspection of the foundation. If the acquirer is weak, the whole thing comes crashing down. So the first question is simple. How strong is MasterCraft, all by itself? Are they really in a position of power to be making a move this big?
So, the first thing you see is the official story coming straight from the bridge. The CEO, Brad Nelson, is projecting nothing but pure confidence. He's talking about exceeding expectations, building momentum. This is the narrative they're pushing to Wall Street, that they are operating from a position of absolute strength. But here at Iron Financial, you know we don't just take the captain's word for it, we go below deck and check the numbers ourselves.
And here you go. This is why he's so confident. The numbers are rock solid. Net sales are up over 13%, which is strong, but that's not the real story. The real story, the one that tells you how healthy this business is the margin expansion. A 440 basis point jump in gross margin, that's a massive move. It tells you they're not just selling more boats, they're making a heck of a lot more profit on every single one. That screams pricing power, or it screams incredibly tight cost controls. Probably both. And then you look at the bottom line, wow. Adjusted EBITDA more than doubles, up 114%. And adjusted EPS, it didn't just grow, it absolutely exploded, up 190%. These aren't just earnings beats, these are blowouts. MasterCraft is firing on all cylinders.
And here's the kicker, the most crucial part of their foundation. Before they even thought about this merger, MasterCraft was sitting on a fortress. Over $80 million in cash and short-term investments. And here's the part that really matters. Zero debt. A completely clean balance sheet. That gives them incredible flexibility and firepower. They are not making this move out of weakness or desperation. They are making it from a position of absolute financial strength. This is the solid hull they plan to build this empire on.
Okay. A strong foundation is one thing. I'll grant you that. Those Q2 numbers are impressive. But you know what? The strongest foundation in the world can't save a building with flawed architectural plans. So now we need to look at the blueprint for this merger. What exactly are they trying to build here? And more importantly, is the design even sound? Let's scrutinize the actual deal.
All right, let's break down the two players. On one side, you've got MasterCraft. They're the king of premium towboats for things like wakeboarding, and they have a strong presence in pontoons with Crest and Belize. On the other side, you've got Marine Products. They own the iconic Chaparral brand for recreational powerboats and the incredibly powerful Robalo brand in the sport fishing world. Now, management used a key phrase here, and you really need to listen to this. Zero cannibalization. Their markets don't overlap at all. This isn't about two companies fighting for the same customer. This is about pure expansion into totally new segments of the boating market. So here are the nuts and bolts of how this gets done. It's a classic cash and stock deal. For every single share of Marine Products, ticker MPX, an investor gets $2.43 in cash, plus just under a quarter of a share of MasterCraft stock. When they announced this, it valued each MPX share at about $7.79. That puts the total price tag, the total transaction value, at roughly $232 million. And MasterCraft is using that fortress balance sheet we just talked about, that big pile of cash, to fund the cash part of the deal.
Right. Now this is where it gets really interesting for me, the ownership structure. Sure, the current MasterCraft shareholders will own about 2/3 of the new combined company. They'll still be in control. But look at the other slice. The former Marine Products shareholders, they're walking away with a massive 33.5% stake in the new entity. So yeah, MasterCraft is the buyer, but they're giving up a full third of their company to make this happen. That is some serious dilution for the people who already own the stock. And it brings up the billion-dollar question, is what they're getting in return really worth giving up that much of the pie?
And that is exactly the right question to be asking. So let's lay out the bull case. What's the grand strategic vision that justifies diluting your shareholders by a third? Management believes they are not just buying brands, they are forging a new, more powerful fleet. Let's look at how all these pieces are supposed to fit together.
Okay, this is the story that management is selling to investors, and you have to admit it's a compelling one. They argue they're creating a truly diversified portfolio with 5 proven, powerful brands. They're instantly expanding their dealer network to over 500 locations, more than doubling their reach to the end consumer. And this is crucial. This deal unlocks growth in the massive coastal and saltwater fishing markets, a huge segment where MasterCraft had basically zero presence before. And they're convinced they can do all of this while making their manufacturing and product development even better. And, critically, they can do it all while keeping that fortress, debt-free balance sheet even after the deal closes.
And this slide just perfectly illustrates what they're trying to build. You can call it the new armada. Look at this combined portfolio in all its glory. They go from being a specialist, a master of towboats and pontoons, to a diversified maritime powerhouse. You've got MasterCraft for the high-performance wakeboard crowd. You have Crest and Belize for the families cruising on the lake. You have Chaparral for the general recreational boater. And then you add Robalo for the serious sport fisherman chasing tuna offshore. This is a quantum leap in market coverage, from a quiet inland lake to the deep blue sea.
Hold on a second. A bigger fleet, a new armada. It all sounds great on a PowerPoint slide. But let's be real. A collection of brands isn't a strategy, it's just a holding company. The real value in any merger comes from synergy, that magic idea that 1 + 1 = 3. So far, all I'm really seeing is 1 + 1 = 2. So, where's the extra value? Where does the real money get created? Let's talk about the synergies.
All right, let's talk money. The first, easiest, and most tangible layer of synergy is this number right here, $6 million. This is the low-hanging fruit, the easy win. Marine Products is a public company. By acquiring them and taking them private, MasterCraft can immediately eliminate all the costs that go with that. Public filings, redundant corporate overhead, duplicate executive salaries, poof, they're gone. They expect to save $6 million a year right out of the gate.
Wait, $6 million? That's it? Let's put that in perspective. On a combined basis, we're talking about a company that's going to have sales well over $500 million. $6 million is what? Just over 1% of revenue? That's a rounding error. That is table stakes. You don't justify a $232 million price tag and 33% dilution for $6 million bucks. So this is the whole game right here. Where do the real synergies come from? I'm not talking about the easy accounting stuff. I'm talking about the heavy lifting, the operational synergies, leveraging their new, massive scale to get better prices on engines and fiberglass, sharing manufacturing best practices between factories to build boats faster and cheaper, cross-pollinating ideas between their R&D departments. Management talks a big game about all this, but they haven't put a hard number on it. And you know why? Because it's really, really hard to do. It's speculative, and it carries massive execution risk. This is where big, ambitious deals fall apart.
Exactly. And that brings us right to the bear case. Let's start kicking the tires and stress testing this deal. You know, the presentation from management is all blue skies and smooth sailing ahead. But we need to look for the hidden reefs, the potential cracks in the hull, because there are some pretty significant headwinds out there that investors need to be paying very close attention to. First off, let's look at the guidance. Yes, they raised their full-year guidance, and that's the headline they want you to see. But if you dig into the details, they also issued third-quarter guidance that actually fell short of what analysts were expecting. They're guiding to 35 cents for Q3 earnings per share, but the street was looking for something closer to 38 cents. Now, that suggests there's some near-term weakness. It raises a really uncomfortable question: why is the immediate future looking a little soft, even as they're painting this rosy picture for the full year? Is there a slowdown coming right around the corner that they're not fully telling us about?
Market skeptic. Next up, you've got legal risk. This deal is now officially under investigation by the law firm Helper Sadeh. They're probing whether the transaction is actually fair to the existing MasterCraft shareholders. Now look, these kinds of investigations happen all the time, but they add a serious layer of uncertainty. It means this is not a done deal yet. There could be legal challenges, there could be delays, there could even be changes to the terms of the deal. It's a storm cloud on the horizon, and you just can't ignore it.
And this gets to the absolute heart of the long-term question for investors: return on invested capital, or ROIC. To put it simply, is MasterCraft going to make enough profit from this acquisition to justify the $230+ million price tag and all that shareholder dilution? Some analysts are really worried about this. If the new, bigger company can't generate a high rate of return on that massive new investment, then they're just getting bigger for the sake of getting bigger.
And that doesn't create shareholder value, it destroys it. And finally, let's just zoom out and look at the market itself. This isn't my opinion, this is from management's own commentary on their earnings call. They are building their entire forecast on the assumption that the retail market for boats will actually contract by 5 to 10% this year. They said, and I'm quoting here, there has been no sustained breakout in consumer demand. So think about that. They are executing this massive, complex, transformational merger right into the teeth of a declining market. That is a huge headwind. It takes flawless execution to integrate two big companies in a strong market. Trying to do it in a weak one, that's like playing on the highest difficulty setting.
All right, you have heard the bull case for forging a new maritime empire, and you've heard the bear case, highlighting the potential cracks in the hull. Now it's time to put it all on the scales. It's time to weigh the evidence from both sides and deliver the iron verdict. Is this a golden opportunity for investors, or is it a dangerous trap?
So, when you boil it all down, here's what you've got. The bull case is built on a really powerful strategic logic. You can't argue with the fit, it's strong, it's complementary, and there is zero product cannibalization. The new combined company will have a dominant, diversified portfolio of brands, and most importantly, it will still have that fortress balance sheet with no debt. That gives it incredible resilience. And you have at least $6 million in clear, quantifiable cost savings from day one. That's money in the bank. But on the other side of the scale, the bear case is just as heavy. The execution risk on those bigger, more important synergies is immense. The valuation, paying 7.2 times forward EBITDA, isn't exactly a bargain, especially for a deal in a highly cyclical industry. The near-term market headwinds are very real, and they're acknowledged by management themselves. And you just cannot ignore the fact that the current MasterCraft shareholders are seeing their ownership stake get watered down by a third to make this deal happen.
So, that's the ultimate question we're left with. Is this a watertight, brilliantly engineered strategy, or is it a high-stakes gamble in a choppy market? The vision of what this company could become is powerful, no doubt, but the risks, both in the market and in the execution of the deal itself, are very, very real. It's up to you, the investor, to weigh that evidence and decide if this is a vessel you want to be on for the journey ahead. Thanks for joining us on Iron Financial. Don't forget to subscribe for more deep dives into the deals that are forging the future of the market.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.